OPEC has just made a major move and it's throwing America's energy strategy off course. For a while, it seemed like the US had everything under control. Domestic oil production soared, LNG exports surged, and Washington sent a clear message. We don't need you anymore. But OPEC is pushing back. They've tightened their grip on global supply, raised prices on their terms, and reminded the US who still calls the shots in the oil world. This isn't just a pricing issue. It's a battle for power, and things are about to get serious. OPEC isn't reacting impulsively. This move is calculated. Here's why. US shale oil flooded the market, undercutting OPEC's dominance and threatening their market share. American energy exports to places like India and Europe started nibbling at OPEC's traditional territories. OPEC saw the challenge and responded strategically. Cut production, control the market, and push prices higher. Their goal, take back the wheel and remind the world that OPEC remains central to the global energy game. Trump's energy plan wasn't just about drilling oil. It was about reshaping America's global standing. The strategy? Drill big, drill fast, and dominate the market. Federal lands were opened, production hit record highs, and for a while, it seemed like energy independence was within reach. US exports surged, prices dropped, and OPEC's influence waned. But there's a catch. Boosting production is one thing. Controlling the global market is another. Now, with OPEC fighting back harder than ever, the cracks in that strategy are becoming clearer. OPEC isn't a monolithic entity. It's a collection of countries with different priorities, and the rivalry between Saudi Arabia and Iran is especially complex. But right now, there's a fragile truce. Both nations have a common goal: push back against US influence in the oil market. Iran recently called for OPEC to unite against US sanctions, while Saudi Arabia is using its production power to control prices. It's an uneasy alliance, but it's holding, for now. And that makes OPEC's response even more potent. The moment OPEC made its move, the markets felt it. Oil prices spiked quickly, with traders scrambling to adapt to the new reality. The combination of OPEC's production cuts and sanctions on Russian oil left global markets in a tough spot. And it's not just about crude prices. Energy stocks are moving. Oil-linked currencies are fluctuating, and investors are closely monitoring every development. For now, the market is on edge. The longer this standoff lasts, the greater the risk of price spikes and bigger disruptions. The US produces a lot of oil, but it still relies on the global market. Here's the problem. Not all crude oil is the same. US shale oil is light and sweet, but many American refineries are built to process heavier crude, which mainly comes from OPEC countries. When OPEC cuts supply, these refineries can't just switch to local oil without costly upgrades. This leaves the US with two choices: pay more for imports or cut back on production. So, while the US is closer than ever to energy independence, it's not quite there yet. And OPEC knows it. OPEC's move isn't just a market shift. It's highlighting a significant issue for the US. Yes, US oil production is booming. But here's the catch. Refineries need heavier crude for certain products. And who controls that supply? OPEC. When they cut back, American refineries can't simply replace it locally, which leads to higher costs and tighter supply. The bottom line? The US isn't as energy independent as it seems. So what's next for the US? Two options: diplomacy or a counterstrike. Diplomatic talks could ease tensions, but convincing OPEC to cooperate isn't easy. Each member nation has its own agenda, and negotiating with such a divided group is like herding cats. Then there's the retaliation option. Flood the market with US oil, put pressure on OPEC, and force a response. Sounds bold, right? But it's risky. One wrong move could send prices skyrocketing. Right now, US leaders are carefully weighing each step, knowing there's no margin for error. The battle between the US and OPEC is having global ramifications. Major oil-importing nations like India, China, and Europe are watching closely. A prolonged standoff means rising costs and potential supply shortages, especially for countries that can't quickly pivot to new suppliers. Some are already taking action. For example, India is locking in LNG deals with the US to reduce its reliance on OPEC. European countries are making significant investments in renewable energy, hoping to shield themselves from future oil price shocks. But this isn't just about the current moment. It's a larger global power struggle. The nations that adapt quickly will come out on top. Not all countries are struggling in this standoff. Some are quietly advancing. Russia and Iran, for example, are stepping up, securing new energy deals in Asia and the Middle East, while the US and OPEC battle for dominance. These countries are expanding their influence. Meanwhile, nations like Malaysia and Vietnam are positioning themselves as regional energy hubs, preparing to play a more significant role in global trade. In every crisis, someone gains ground, and right now, the quickest movers are securing deals that will shape the energy market for years to come. For consumers, this isn't just about global politics. It's about the money coming out of your pocket. Gas prices are steadily rising, and heating costs are likely next. Since transportation costs impact everything from groceries to delivery fees to retail, the price hikes will affect you well beyond the pump. In some regions, even electricity rates are tied to oil prices, which could lead to unexpected spikes in your energy bills. So how long will this last? It depends on what happens next. But if instability continues, these price increases won't disappear anytime soon. OPEC isn't thinking about the next few months. They're playing the long game. It's not just about today's prices, but about controlling the energy market for years to come. Countries like Saudi Arabia and Iraq are boosting production capacity while carefully managing exports to protect their long-term market share. Iraq's recent discovery of a massive oil field near Baghdad is just one example. While the U.S. focuses on short-term wins, OPEC is positioning itself for the next decade. Their goal is simple: maintain control and stay essential, ensuring the world can't move on without them. The U.S. isn't ignoring what's happening, it's adjusting. But the energy strategy is becoming more complex. Increased production from federal lands and offshore reserves has helped boost U.S. exports, but that alone isn't enough to counter OPEC's latest moves. Now there's a growing debate over what the next step should be. Some want to double down on domestic oil production, while others push for a pivot toward renewables and new energy technologies. The issue? Neither option is a quick fix. Expanding oil production takes years, and renewable infrastructure can't replace oil overnight. This leaves U.S. energy policy in a delicate balancing act, caught between long-term goals and immediate market pressures. Whenever oil prices spike, renewables take center stage. But the question remains, how realistic are they as a solution? Wind, solar, and battery technologies are growing fast, but the global economy still relies on oil. Transitioning away from oil will take time, lots of it. Meanwhile, countries like China are investing heavily in clean energy, while also maintaining fossil fuel reserves to avoid energy shocks. For the U.S., diversifying energy sources is a smart move, but oil will remain a critical part of the mix for the foreseeable future. The reality is that renewables are part of the answer, but they won't replace OPEC's influence anytime soon. Investors are on edge, as every OPEC announcement sends shockwaves through oil markets. And the stakes are rising. So what's coming next? Oil prices could stay high if OPEC sticks to its current position. Any unexpected production increase could bring prices down quickly, but that would come at a political cost. Sanctions on Russian oil exports are also adding pressure, creating more uncertainty. For now, markets are in a wait-and-see mode, watching how the U.S. and OPEC leaders respond to this growing standoff. So what's the future? A few scenarios are possible, each with significant consequences. Prolonged standoff. OPEC holds its ground, prices remain high, and the U.S. scrambles to adjust. Consumers will feel it in their wallets, and businesses will face higher operating costs. Short-term truce. Diplomatic talks calm the situation temporarily, but if the deeper issues aren't addressed, tensions could flare up again. Market reshuffle. Countries diversify their energy supply, renewables grow faster, and the global energy market shifts permanently, reducing OPEC's long-term influence. For now, all eyes are on OPEC and Washington, waiting to see who makes the next move. So here's the real question. Who's going to act next? Will OPEC maintain its hold, keeping prices high? Or will the U.S. take bold steps to regain control? One thing is clear, this story is far from over. The decisions made in the next few months could reshape global energy markets for years. What do you think? Will OPEC keep dominating, or will the U.S. find a way to counter it? Let us know in the comments below. We'd love to hear from you. And if you found value in this breakdown, don't forget to like, subscribe, and hit that notification bell so you never miss our next deep dive into the biggest global stories. Thanks for watching, and we'll see you in the next one.